Hello, today I would like to walk through a few journal entries that were recorded incorrectly and explain what will be the effects on net income. So we have the following exercise. Equipment with a useful life of 5 years was purchased and expensed in year 2018. So useful life is 5 years. And we need to figure out what will be the effect on 2020 net income and 2021 net income. When I do the years, I usually set up two columns. In one column will be what the company did and what they should have done. And I actually went ahead and added year 2018, even though they didn't ask about it. So we did this journal entry that kind of looks weird because we expensed an asset right here. And it should have been capitalized in 2018. So you can see in 2020, nothing is happening, and in 2021. But we should be recording depreciation expense. Why am I looking only at the depreciation expense account? Because if we do net income effects, we're looking at revenues, expenses, gains, and losses. So these are the four items that we need. So we should have had an increase in depreciation in both years, but we didn't do that. As a result, our expenses will be too low. Again, expenses too low, and then net income will be too high in both years. Net income is too high. Okay, let's take a look at C. Because C is very much alike. The equipment that was purchased in 2020 was expensed. So here's the year 2020, and we again had an expense. So expenses are too high, overstated. Why? Because we should have capitalized that equipment and that was recorded as an asset. Yeah, we do have expense coming in as depreciation, but it will be nearly not as huge as equipment expense, right? If you do a straight line, it will be only 1/5 roughly, as opposed to equipment expense. So it's still overstated more than it should be. If expenses are overstated, then net income will be understated for year 2020. What about year 2021? We are missing expenses. So instead of recording depreciation, we don't have anything. So our expenses are too low. They should have been going up, but they're too low. And net income, as a result, is way too high. We have so far, both the prior errors were non-counterbalancing errors, meaning they will not self-correct within 2 years. So you have to run through the useful life of equipment to get it off the books, and then it's all gone. How about this one? This is wages payable. Wages payable were not accrued at year end at 12/31/20. So what we did nothing. Okay, what we should have done, we should have increased our expenses. Okay, so as a result, our expenses are too low, understated. So that means net income is overstated because it's adverse relationship. And then in year 21, we went ahead and paid our payroll. So expenses, instead of showing up in 2020, they're an expense in 2021. So expenses now are too high, and net income will be too low. Okay, because as you can see at should have done, there's no expense account affected here. And if you look at both years together, do you see how net income is overstated in year 2020 and then understated by the same amount in year 2021? So when you close net income in retained earnings in 2021, retained earnings will also be overstated. I'm going to go ahead and jot it down because it is asked on the CPA exam a lot. So retained earnings will also be overstated. But if you look at year 2021 and close low net income, and net income is lower by exact same amount. So there will be a zero effect on retained earnings, because remember, it's a permanent account, so you will have accumulation over 2 years. So this is a counterbalancing error. It will counterbalance or self-correct within 2 years. How about we'll take a look at the your next one. Ooh, got messed up a little bit. My arrows got kind of moved a little bit. I apologize for that. And I lost my pretty color. My slide background was beautiful, and now it's kind of brown. Oh well. So inventory errors. I do have a separate video recorded specifically for inventory errors, because those show up a lot and they're a little bit tricky. So what if in 2020 ending inventory was miscounted and it turned out to be too high? Net income, not net income, ending inventory has a teeter-totter relationship with cost of goods sold, because they're both parts of goods available for sale. So if ending inventory is overstated or too high, then cost of goods sold will be automatically understated. And as a result, you remember that net income has adverse relationship with cost of goods sold, so net income will be overstated for year 2020. Let's take a look at the next year. So next year, when we wake up in January 1st, ending inventory that we had last year became our beginning inventory. So if ending inventory was overstated last year, beginning inventory this year is overstated. As a result, your goods available for sale are also too high, too large. And because your ending inventory was counted correctly, that's our assumption that we don't have a double error, then it forces cost of goods sold to be overstated. Again, goods available for sale are too high, that pizza pie that I draw is too big, ending inventory slice is exact, normal, correct amount. As a result, cost of goods sold is too high. And if you remember, cost of goods sold, it's an expense, will have an adverse relationship with net income, so net income will be understated. And just like with wages expense or wages payable, we have a counterbalancing error with inventory. It will self-correct in 2 years. How about the last one? Patent amortization was not recorded in 2021. So 2020 is not affected because it happened in 2021. And we should have recorded amortization expense, and expenses should have gone up, but we forgot to do that. So as a result, my expenses are too low, understated. Okay, so we didn't increase the expense. And net income will be overstated for that particular year. That's it, guys. Thank you so much for listening.